Let's connect with Subir Gokarn now, Director Research of Brookings India and former Deputy Governor of Reserve Bank of India. Mr. Gokarn, good morning and thank you for joining us. Mr. Gokarn, the current account deficit or the CAD is likely to be as low as $56 billion. Do you think that we have made significant improvement in structurally reducing our CAD?
I think there are four structural drivers of this high CAD. One has been long-standing, which is crude oil, and that is something that can only be addressed through both right pricing and a emphasis on conservation, both of which are currently not quite in the picture. We're getting there on pricing, but we're not quite there, and I think we need to re-emphasize now the value of conservation apart from the price impact on it. The second is gold, and there we need to see a significant inducement for people to shift away from physical investment in gold, and even if they want to continue to invest in gold, create financial or what I would call dematerialized alternatives. And there are options available which we need to not only design and put in place, but also sell quite aggressively. I think the marketing aspect of this is very important. The third is coal. We are now importing about $8 billion worth of, at least in the last financial year, $8 billion worth of steam coal or non-coking coal, which is going in mainly to fuel our power plants because we couldn't get our domestic coal supplies on track. And that's something we have to address as quickly as possible. And the fourth is on iron ore. We stopped exporting iron ore. We've lost roughly $4.5–5 billion worth of exports on iron ore from their peak, and because of environmental compliance issues, and we have to find a way to get that iron ore back into the market within the boundaries of environmental compliance as soon as possible. So there are structural drivers of the current account deficit. We should not be complacent about this most recent shrinkage, because this is essentially cyclical in the sense that partly exports are benefiting from the rupee depreciation, and partly domestic producers who compete against imports are also becoming more competitive because of depreciation. So this is a positive outcome of depreciation, but it does not fully solve the current account problem.
Mr. Gokarn, the second quarter GDP is going to be announced on 29th. Your expectation on the same, and what's the possibility that we do achieve a 5% FY14 GDP growth?
Well, I've been out of the forecasting game for quite some time now, so I will not venture a specific number. When we look at the convergence of projections for the year, we're seeing some sort of a bunching around the 4.5% mark. So I think somewhere between 4.5 and 5 is perhaps feasible. We're seeing, in the last few months, some revival in exports. Expectations from agriculture are fairly positive. So I don't know whether 5 will be achieved or not, but I don't expect the number to be too far below 5 when it does come out. I'm talking about the year as a whole. I don't have a specific view on the Q2 numbers.
But what is your view on inflation, both WPI and CPI, and how much of our inflationary expectations in the supply side is largely demand driven, and what according to you needs to be done by the government to tackle the supply side bottlenecks?
Well, I think when we look at the dominant driver of high CPI inflation, and also to an extent WPI, because the weights are different for food in the two indices. But food inflation has been with us now as a persistent and I think very deep-rooted problem for the last several years, 6 years or so. It's been running at above 10% year-on-year for around that period, with a few, very, very few exceptions on a month-by-month basis. This suggests that there is something fundamentally wrong with the food supply chain, that there simply isn't enough of what is being most demanded by consumers produced by the system. So we need to see a significant reorientation, both of the incentive structure, which means that farmers have to have the opportunity and the pressure and the incentive to respond to what consumers are actually consuming, as opposed to what the government has decided to procure, which I think is a significant reason for this disconnect between the supply side and the demand side. And we also need to back that up with the right kinds of investments, both in terms of actual cultivation and in terms of the support infrastructure, transport, storage, power, irrigation, and so on. So all of these call for a massive, coordinated, integrated plan for agriculture. I think along the lines that we saw in the late 60s, which is how we broke out of years and years of being on the edge as far as basic staples are concerned, as far as rice and wheat were concerned, and moved to a very significantly new and improved situation. So what was called the Green Revolution then, Green Revolution, perhaps that was phase 1. I think we're primed for a Green Revolution phase 2, which has to focus not on rice and wheat, but on proteins and vegetables, which are the two big drivers of inflation today.
Mr. Gokarn, although the monetary policy has, seen to be an effective tool to tackle inflation, do you see high interest rates in India for at least the next 4 to 6 months? When do you see the RBI getting some elbow room to cut rates?
I think the model that has now been articulated by Governor Rajan suggests a greater weight being put on CPI numbers. The CPI numbers are still quite high, and that would suggest then consistency would require that rates remain at these levels, if not higher, at least as long as CPI remains close to where it is. Now, there is a projection that the RBI made for CPI inflation for the first time in its October statement, which says that CPI at the year end, which is March 2014, is going to be above 9%. From that perspective, it appears that the real policy rate, which is the policy rate minus the rate of CPI inflation, is still negative, and that would suggest then that there is a possibility of further tightening to get an alignment between the policy rate and the inflation index. Now, unless CPI starts to come down sharply, given the framework that is currently in operation, obviously the expectation would be that rates would not come down. We are, of course, waiting for a more formal articulation of the policy framework over the next couple of months, and we'll have a clearer picture on what the triggers and the response mechanisms are going to be when we have that in place. But for the moment, I think the logic of the last two statements would suggest that there isn't any room actually for interest rates being lowered until at least the CPI number starts to come down quite sharply.
Mr. Gokarn, the RBI governor recently stated that majority of the OMC dollar demand is back in the market. Does that imply that when Reserve Bank of India starts calibrating this window, we may not see a significant impact on the rupee, and hence do you think closer to 61 to 63, rupee now has a firm trading band in place?
I'm hesitant to use the word fair value, because I think that's a very subjective judgment. But I think more objectively we can use the term stable. So this is a range where it appears that the supply of dollars and the demand for dollars from all sources are more or less in sync, more or less in balance, and that means that the currency remains in a relatively narrow range. So I think we are at that point now. If you define 61 to 63 as a range, I think that is a range of stability. And to that extent, moving the demand for dollars by oil marketing companies to the market shouldn't be terribly disruptive.